Swayam Prabha. Digital India. Educated India.
Namaskar. We will now be continuing with our second lecture on the second module of this course on sales management. This particular lecture is lecture 7 and we will be continuing with the previous topic, which is determining sales related marketing policies. In this particular lecture, we should be continuing with the marketing mix policies. In the previous lecture, we have spoken about the basics of sales related marketing policies, and we have also discussed the product and distribution related policies. In this particular lecture, we will be speaking about price related policies. So, let us first begin with the basics of sales related marketing policies, and I will just give you a brief introduction or in fact a quick recap of what we did in the previous session and where we spoke about how important sales related policies are for a salesperson and for the sales executive. While these policies are formulated by the top management, the performance of the sales executives and the sales team actually depends upon these policies, and the manner in which or the success of a salesperson and the sales team depends immensely on the policies which are initiated by the middle and the top management. While the sales team or the sales executive do not play a role in the planning or in the policy or setting up of policies with respect to the marketing mix, their performance is affected, and they do play a very minor role when, if and when the middle and the top management does seek advice or does seek opinion from them. Maybe it is customer feedback, or whether it is customer reaction, or whether there is the middle management or the top management seeks information related to the market conditions or the competitors or the customer reactions or customer suggestions. So, these are things which are this kind of information is collected by the sales team and further transferred to or communicated to the middle management or the top management who formulate these policies. The implementation of the policies is the job of the sales team, and whatever these policies are with respect to the 4 P's, the performance of the sales team and the achievement of the targets and the performance of at the sales office depends immensely on these policies. So, in the we have discussed in the previous lecture that salespersons should get knowledge about the selling and the sales related policies, because it builds confidence in them, and when they are confident about what they are saying and speaking and the manner in which they are communicating with the customers, whether existing or actual, also instills a feeling of confidence in the buyer, and the buyer feels that yes, I am being taken care of. The salesperson is somebody who knows business, who knows things, and I can rely upon him for advice. And in case I do buy a product or a service, I can be convinced that I am doing the right thing, and I can be assured of service in future. So, salespeople must actually have knowledge about their organization. They must have knowledge about the market share, the size of operations of the organization, the kind of products that the organization manufactures and sells. Also, they must have idea about the different kinds of products manufactured, the big clients that the company has, and they should have information about the entire marketing mix, be it the product, the price, the place, or the promotion. So, that would help the salespeople, and that is why the salespeople should have an idea even about the marketing mix policies. So, we will now talk about the pricing policies. Now, pricing policies are related to determining how much and in what way a company would charge from the customers. Majority of the decisions which are taken with respect to purchase decisions are always taken keeping the price in mind. Many of us buy products and services keeping the cost factor in mind. In the case of B2C, we are often driven by deals and discounts and prices. In the case of B2B scenario, it is the quality which matters, but it is also price which matters, and very often companies ask for bids, and the bid goes in favor of those who have quoted the least in terms of pricing. So pricing definitely has a big role to play in determining whether a customer will favor a particular brand or it would favor another brand, and the policies here basically relate to determining how much and in what way a company should charge from its competitors, so that they can gain a competitive edge in the market, keeping in mind the price factor. The prices are such that they give profits, they earn profits for the company, but they also are low enough to to attract people towards them and not towards the competitor. So we will speak about pricing on relative to competition, relative to costs, also policy on uniformity of pricing to different buyers, and on list pricing. So let us start with the first, which is relative to competitor. Here again, the sales executive's roles in the pricing policy is optional, but as I said, their role as regards implementing is undeniable. And again, whenever a salesperson plays a key role, he has to actually talk about prices, he has to disclose the prices to the customers, and he has to convince them for paying a particular price, even if it is against much lesser than the competitor. So that is why competitive pricing is important. The sales executive, as I said, will not have a role again in determining the right price for the company or in setting the price, but they definitely have a major role in implementing the pricing policy. And when he has to sell, the one big question which the customer often asks is, how much does it cost? What do I have to pay? Okay, now here the salesperson has to deal with this tricky question, because he knows that if he the price may be something which may attract the customer, and the customer may patronize this brand or offering, or it may be such that if it is higher than the competitor, then the customer may get swayed away towards the competitor. He may go away towards the competitive offering, and no salesperson would want that. So in such situations, the salesperson tries to talk about the price, and he tries to illustrate the value proposition by saying that what he gives as a product, as a brand, as a service is something which is more value to the customer as compared to the competitor. And then he has to prepare a presentation accordingly, and he has to convince him that what he is charging is the right price and why the customer should be actually paying that price. Okay, so moving further, when we are talking about pricing relative to the competitor, a company, in order to survive, cannot ignore competitors' pricing policy. And price, I would like to say here, I had a few lines, a few sentences more about price. Price is the only P in the marketing mix which is revenue generating. All the other P's, whether it is product, whether it's place, whether it's promotion, are all cost incurring. Okay, so price is the only P which is revenue generating. Second thing very important about price is that it is one of the most flexible P's, or we can change it very quickly as and when we want it. We may reduce it, we may increase it, we may decrease it, we may increase it, we may change it, and it is something which is very flexible, unlike other P's, but it is also very volatile, because it brings in for a lot of changes, a lot of reactions with respect to the various stakeholders. Any price change, whether a price cut or a price rise, will bring on a series of reactions from different stakeholders, be it competitors, be it customers, be it the dealers, the distributors, be it the vendors. So pricing decisions are one of the most crucial decisions that a company actually faces. And coming to the pricing with respect to the competitive offering, a company here will always keep in mind, what is my competitor charging? If I charge the same, should I charge the same, or should I reduce it, or should I increase it? It's going to be perceived differently, absolutely differently, by the different stakeholders. Okay, and it may also lead to a reaction from the competitor, who may initiate a price cut if you've initiated a price cut. If you've gone in for a price increase, he may also go in for a price increase. So it's something which is very, very volatile, and pricing decisions are one of the most crucial decisions that a company has to take. A company, if it has to survive, cannot afford to ignore what the competitor is doing, and in terms of prices, and companies often price the product at the same level at which the competitors are offering. In case they do not, then they try to showcase the product as something which is more superior, which is better in quality, service, or they would like to show how it is a better value proposition than that of the competitor. So in case the competition is not price based, companies can adopt any one of the options. It can either match with the competitors' prices, and so collective wisdom holds, everybody, all competitors in the industry charge the same prices. Okay, so this particular company also decides to charge the same price, because the competitor is charging price X, I must also charge price X. Another could be price above the competitors' prices, where a marketer may have the option of pricing his product higher than what the competitor is doing. Now this is possible only and only when, one, you are offering a value proposition which is more lucrative, two, you have a brand image, and it's a premier brand image, and you can afford to charge higher prices, and people will be ready to buy. Okay, otherwise pricing above competitors' prices may not be very, very easy. Another scenario where you could price is if you are a first mover and you've come up with an innovative offering and it is something absolutely unique and novel. Another option when the marketer has is to price below the competitors' prices. Now this may bring in quick sales, this may bring in market share, but it also is a question mark on the credibility, on the quality, on the value proposition. Why is he charging low than the competitor? It also could mean a dilution of your brand image. Okay, so the marketers can adopt any of these options. They can either match with the competitors' prices, they can price above the competitor, or they can price below the competitor. Now I would like to add here that matching the competitors' prices is the most commonly adopted policy, and not all competitors you will consider, but you will only consider your major competitor. So you will consider your important competitor, and you will try to charge what this relatively important contributor is charging. And in case you charge low, of course it's less common and not always appropriate, as I said, because if you charge low, it would mean a dilution of brand. If you charge high, it would again convey high quality, but again it is less common and not appropriate. And even below, as I said, it would mean you may be able to gain a market share, you may be able to capture a market share, but it's again not very feasible or not very popular, because it could lead to a price war. Also you may feel that in the short run you may feel that I am able to grab a larger market share. Okay, but in the long run you will realize that because of the price war you have suffered a lot of losses. Also you will also realize gradually that by charging less than the competitor, you are actually foregoing the profits which you could earn had you priced similar to the competitor. So these are certain advantages and disadvantages of pricing against the competitor, matching the price, or pricing above or pricing below. If you are matching the competitor, it is fine, it is collective wisdom. You should identify the more powerful ones, the more important ones, and you feel you are providing a value proposition which is equitable, so you price your product similar to that of competitor. Pricing above is not wise, it's not always appropriate, because it could mean that you do not get quick sales, it would also mean that you lose market to the competitor. And until unless you are a first mover, until unless you have innovated, and until unless you have a reason to strongly prove that you offer a better value proposition, it would not be a wise idea to price above the competitor. And if you price below your competitor, again it is not very appropriate, because one, it could lead to a price war. He would also price his product lower, and it will go on and on. Two, you will realize that gradually you are losing out on profits which you could earn if you had kept your profit margins high, similar to that of the competitor. Okay. Now, second is pricing relative to cost. The relationship between the cost of a product and its impact on pricing is undeniable. No marketer, no business organization would like to price its product at losses. It would definitely want to recover all its costs, and any and every wise marketer would definitely want that he should be able to get quick profits for the company. The company should be able to get break even as quickly as possible. The company should be able to get a good return on investment, and so it's important for companies to cover the long run costs of manufacturing the products in order to be profitable. And so sales revenue must equals units sold times the prices charged. We all know that, and it's very important that revenues are earned by the company, and to earn those revenues, it is again essential that you actually price your product at a price, and you are able to sell huge volumes so that you can get sales revenues, and the company can actually make profits. Now, policies on pricing with respect to cost involve full cost pricing, or it is promotion pricing, or it is contribution pricing. So, what is full cost pricing? In the case of full cost pricing, prices are determined in such a manner that total costs are covered. We all know total cost is equal to fixed cost and variable cost. Okay, fixed costs are fixed costs which a company incurs, and variable costs are those which vary per unit of production. So, based on units of production, the variable cost would vary. Fixed cost plus variable cost is equal to total cost, and in case of full cost pricing, prices are determined in such a manner that a company is able to recover the total cost which it has incurred, both fixed cost and variable cost. Second type of pricing which we talk of is promotion pricing, where prices are utilized as a strategic tool for promotion. Offering products at lower prices to promote sales has been a well utilized marketing tool. We know for sales promotion, which are short term incentives which are offered to the customer in the form of deals, in the form of discounts, in the form of other incentives which are used to counter competition, or to elicit trial, boost sales, fight competition. And so promotion pricing is something which is very important for an organization, where prices are utilized as a strategic tool. Products are offered at lower prices to promote sales, either one, when the product is new and the company wants to encourage a trial; two, when the sales are sagging and the company wants to give a boost to the sales. And so in these cases, promotional pricing is used. Promotional pricing is also used when you realize that you want to grab larger market shares and you want to counter the competitor. Contribution pricing. Now, pricing is done at any level above incremental level costs. Incremental level costs are those costs which get affected when level or nature of activity changes. So, for example, manufacturing 10,000 units or 1,000 units will definitely affect the incremental cost. So, based on the incremental cost, pricing is done at any level above the incremental cost, and we call this contribution pricing. All of these, whether it is the competition, whether it is full cost pricing, or whether it is contributory pricing, or whether it is promotion pricing, they all have an impact on the very fact that whether a sale would happen or not happen, keeping in mind the manner in which the price is presented to the potential or to the prospective client. Now we come to the next, which is policies with respect to uniformity of prices to different buyers. Now, when it comes to charging different buyers or different segments, the company has the option of either choosing one price policy or a variable price policy. Under one price policy, all buyers are quoted the same price. So, irrespective of the segment, irrespective of the fact that whether it is a B2B or a B2C scenario, whether it is segments with respect to age or gender or income levels or any of those, the people are charged the same, they are quoted the same price. Under variable price policy, the prices which are charged from the customer are based upon individual bargaining and negotiation. So, different buyers and different segments may be charged differently, and they would pay differently to the seller. Now, some kind of variable pricing is acceptable, is regarded as acceptable, but sometimes it is taken as discrimination. So when we talk of pricing and pricing which is not the same, and it's not one price but a variable price, we also discuss something which is called price discrimination. Now price discrimination happens when the seller is going to charge differently from different buyers or from different segments. So he may charge higher or lower depending upon several things. One, it could be because of the nature of the segment, with B2B, B2C, age effects, gender, or socioeconomic classes. Or so this is one. Another kind of discrimination may occur when the seller charges based higher or lower based on urgency or immediacy of requirement or need fulfillment. And another case would be when people buy in, want to pay in have longer payment terms, or want to buy in bulk, or have certain specific requirements. So in certain cases a company may go in for a variable price policy where it may charge different from different buyers or different segments. Now what are the advantages of a one price policy? Salespeople spend less time in negotiation, the prices are already fixed, and whatever is quoted as a price is charged. There is no there is no question of a bargaining or of a negotiation, and so he does not it does not lead to an embarrassing situation for him to reduce prices. There is no risk for bad mouthing of the company also over differential pricing in case the customers have access to each other, because they know that there is nothing called differential pricing. It is all one price which is charged from everybody. But with respect to variable pricing, it is more applicable in B2B scenario where products are sold in large volumes, and but even otherwise when it is done as I said, in certain cases the discrimination is regarded as something which is acceptable, which is fair, but in others it may be treated as something which is unfair and unjust on the part of the marketer. Now policies on list pricing. Now list pricing again helps control intermediaries, resale pricing, and aims at striking a parity in prices. The most common form of list pricing is selling on the basis of price printed on the package. So you have the MRP listed there, and the buyer pays what is listed. It is more apt to use list pricing when marketers utilize an exclusive or a selective distribution channel, because there in those cases there is no way where the buyer would want to negotiate further. Okay, but in the case of intensive distribution channels, the buyer may want to bargain or want to negotiate. So list price is used when marketers utilize an exclusive or a selective distribution channel. Trade discounts and quantity discounts. Now companies also have policies on discounts. Trade discounts are those which are offered to wholesalers and retailers. The amount of discount offered to them will vary with respect to the product or with respect to importance that the retailer or wholesaler has with the company and with the marketer. So the more important, the more significant he is, the better he is in his work, the higher potential he has, the better he is with interpersonal relationships with the company. So he stands to gain higher in those cases. So here the amount of discount which is offered will depend upon one, the potential that the wholesaler or the retailer has, the kind of sales that he gives to the company, two, his interpersonal skills, interpersonal relationships with the company and with the salespeople, three, the reputation of and the popularity of the wholesaler or the retailer in the market with the customers. So in those cases trade discounts which are offered are higher. On the contrary, in case where wholesalers and retailers are do not have high potentials or are not very fruitful for the company, in those cases those discounts will be lower. Discounts are also offered when products are purchased in bulk. Now quantity discounts help marketers in promoting sales, and when people buy in bulk, the companies offer them quantity discounts. Now the next we come to is geographical pricing. So pricing can also be varied keeping in mind the geographical location or the location, how far is it from the manufacturing unit, what would be travel and transportation charges, what would be logistic charges, how far or how long will it take to travel. So keeping all these things in mind, the prices are adapted with the geography aspect. So prices vary depending upon who is also prices are also depend upon who is paying the freight charges. The farthest to the customer, the higher are the freight charges, it's again we have alternatives in charging freights. We have free on board, where the customer pays the freight, the buyer adds the freight to the factory price. We have something called the delivered pricing, where the marketer pays the freight but includes them in the price quotations. So it is more apt when freight charges account for only a part of the product's price. And freight absorption is when there is a compromise between the freight on board and the delivered prices. So if the free on board or is FOB pricing, where the customer pays the freight and the buyer adds freight to the factory price. Delivered pricing is when the marketer pays the freight and he includes it in the price quotation. It is very useful when the freight charges are very small and only a part of the product price. And freight absorption is when it is a compromise between the free on board or the FOB and the delivered pricing. Price leadership is again an important issue. Price leaders are those who are followed by other players in the market with respect to implementing price changes. So there may be a company which is always in the lead to initiate price cuts or to initiate price increases, and price leaders are usually the biggest players in the market, and the others follow them then. So they have to the others who are following them quickly have to adapt. If the leader has increased the prices, the others must act. If the leader has reduced prices, again the others must act. So the price leaders, they determine the pricing patterns, and price followers are the one who initiate price changes by following the leaders. So the actual price changes are done by the market leaders, the bigger players in the market, and the market followers are the ones who initiate the price changes by following what the leader is doing. Competitive bid pricing is where when institutional buyers, government buyers or industrial buyers, they solicit bids. It's a norm in many companies which is basically utilized by making purchases. Proposals are invited, their proposals are solicited, and they are evaluated in terms of pre-communicated parameters or standards like pricing, reputation of the dealer, business lines carried by them, the financial status, the delivery dates, additional services that the channel partners can offer or the other members can offer, and based on this they decide on the pricing. So proposals are invited and evaluated in terms of communication pre-communicated parameters like the prices or the reputation of the organization or of the marketer or the seller, his flexibility, similar lines of business which he is catering to, his financial status, the additional services that he can provide, his flexibility, his reputation, his quality, etc. And then finally the bid, it is decided who would actually be given the bid. So competitive pricing is a norm with many companies which is basically utilized by making purchases. Product line pricing, it involves pricing related to the products that fall under one product line. Basically the products in a particular product line will also compete with each other in capturing market share. Sometimes it also leads to cannibalization when one product eats away into the market share of the other. So it's very important to have right price differences to avoid any kind of cannibalization or to avoid any kind of price confusion. So products in a product line may compete with each other, and it's very important that you have clear cut differences in the product variants. You must position them as different products meant for different segments, otherwise they may cannibalize each other. And it's also important to have right price differences to avoid any kind of confusion in the customer's mind. Some prices, some products may be priced very high, some products may be priced with the midpoint, some products may be priced at the lower points, so that depending upon the target market for which they are meant, so that the products in the product line do not compete with each other. With this we come to an end of this particular session. The references are Still and Cundiff, Govani and Puri, Sales and Distribution Management, 6th edition 2017, Pearson India Education Services. This brings us to an end of the second lecture on the second module of the course. Thank you.